Thanks for joining us today, everyone, for this briefing on the current global energy shock. I'm joined by Chief Economist Ivan Colhoun, who is well qualified to discuss this matter and provide you with a couple of scenarios and what this might mean for the economy and the credit risk outlook going forward. Good morning to you, Ivan.
Hi, Michael.
Okay, we'll just run through a couple of quick slides beforehand for those of you who aren't familiar with CreditorWatch. We're a B2B only credit reporting agency. We were founded in 2010 and we provide an end-to-end product suite from onboarding to account management through to our great collections tool, Collect, to help keep your cash flow coming in and your collections rate at a healthy level. We have more than 50 private and public data sources that we use to put our data together. You can see there common data. We take data from ASIC. We have an intraday feed from ASIC. We collect ATO tax default data on debts of greater than $100,000. We're seeing that go up. The Australian Business Register, Australian courts, AFSA, and insolvency notices there from ASIC as well. Some of our proprietary data that we've compiled over the past 15 years includes our default data, mercantile inquiries, credit inquiries, so lookups on our platform. We also have a number of unique software integrations with accounting software providers. So we have more than 12,000 trade lines of data that we share with our subscribers. Okay. So I'm sure you're all keen to get into this. It's obviously a very hot topic at the moment, the issue of the global energy shock and the impacts of that filter throughout the economy. We're seeing a lot of impacts on sectors within the economy that are most important to the functioning of the economy. So things like transport and infrastructure, transport and logistics, I should say. We're seeing construction impacted, obviously, and manufacturing. Ivan will go into that in a lot more detail, but yeah, we're seeing our business index data is providing some pretty shocking warnings for the economy going forward, which I'll now hand over to Ivan to take you through in a bit more detail.
Okay, thanks, Michael. So I've been starting every presentation I've been doing for CreditorWatch for the last couple of years with this slide. And it's really to say there's some very big themes running through economies at the moment that are changing business, changing risk, changing credit risk. And of course, at the moment, geopolitics has raised its ugly head, if you like. But I do want to talk a little bit about AI, because it was only just over 4 weeks ago when that was all the rage in markets, and that hasn't changed because there's an energy shock. So that's still a very big change going on in economies, affecting business models, just as we've got an energy shock, which is obviously very important for the near term. But one of the big unknowns, and I'll talk about, I guess, different ends of the energy shock. One of the big unknowns is how long it lasts for, because we may wake up tomorrow or the next day and find that President Trump has achieved his objectives and shipping is flowing through the Strait of Hormuz again. Anyway, let's also look at the baseline. What are we working off? Because I think this is a good way to think about this shock. We had the economy we were facing, the conditions we were facing up until February, and then we have to overlay this big rise in oil prices over the top of it and decide how that will affect businesses. So what we'd seen through much of 2025 was insolvencies moderate, but then you can see right at the end there was quite a lot of volatility in the data, but it probably looks like insolvencies just started to trend up a little bit at that time. And that was interesting because there was no increase in interest rates in that data. There'd actually been interest rate cuts, and of course we'd had the income tax cuts the previous year. So the scenario wasn't looking quite as positive before this shock. When we look at the first half of the year, two of the sectors that had the worst insolvencies or have had the worst insolvency in recent times, which has been hospitality and construction, they'd actually improved a bit, and it was actually retail and transport where we had seen a pickup in insolvencies in the last little while. You'll notice mining is at the top of that table. I think that's not really a good indication. There was 1 month in July where there were quite a few insolvencies, but after that it's been very flat, and it's actually probably, along with agriculture, still one of the better performing sectors as we headed into this latest shock. When we look at our trade payment default series, and these are some of the series that Michael spoke about, we could see that improvement over much of 2025, but then a lift into the latter part of the year. Not dramatic, but not as low as it has been. This is a very good indication of potential insolvency. If firms have got even one trade payment default registered against them, it very much increases the probability of insolvency. And if you get two or more, this doubles or more again. And as Michael said, or as I was saying before, you can see that for food and beverage, the trend had actually come down a little bit. For construction, it was still quite high, and it was pretty high in the last month of the year, so that is probably a bit of a warning. And then retail and transport, generally there'd been an upward trend, so it was confirming those trends we were seeing in insolvencies. And then the tax defaults, which the process the ATO goes through to say that before it actually even gets to, I don't know if outing's the right word, but registering a company as having more than $100,000 owing, there is a process. And you can see in the last couple of months of the year, including in December, that was quite high, and it just looks like we're seeing more companies owing the tax office a bigger amount of money again. So that and the trade payment default trends seem to say that things were not quite as good as they had been in the economy at the end of last year.
Just jump in there, Ivan. I think it's important to note as well in that data that in terms of the composition, more than half of those outstanding debts are with sole traders. So it's pretty disturbing when you consider that there's about 18,000 out there that are carrying a tax debt of more than $100,000.
That's definitely disturbing. One positive, I guess, of that is the number of people employed by those businesses is not as high, and I guess we have seen a lot of sole traders get into trouble in the last few years, and that's probably a reason we haven't had as big an impact on unemployment or flow-on insolvency effects from the rise in insolvencies that we've seen to date. So yeah, that's a very good point, Michael.
Sorry, just one more thing I forgot to mention at the start. If you do have any questions that you'd like Ivan to answer, just enter them in the field there on your right-hand side, and we'll get to those.
So a while back, we decided to try and work out how to model the rate of insolvencies and look statistically what were the biggest explainers of the rise in insolvencies that we saw through out of the COVID lows. And it was very interesting that the models, when you look at it, said historically it's been interest rates and energy prices that have the most explanatory power in determining what's happening with insolvencies. And obviously through much of the 2010s, interest rates were trending lower, and energy prices for the most part were pretty well behaved through that period as well. Now, that's really important because when we think about what's going to be impacting the economy and businesses and insolvencies, we've got interest rates with a different sign to what they had in 2025. We had 3 cuts. We've already had 2 increases this year. And of course, we've got energy prices much higher for an unknown length of time, and we're not sure whether they'll go still higher. So in a macro sense, these 2 important drivers are saying, look, the insolvency picture is likely to deteriorate going forward. And a big part of that will be dependent on how long and how high energy prices go and how long they stay elevated. The other point I keep liking to reinforce is that the RBA keeps talking about getting inflation back to target, which is their target's 2.5%. They got it briefly there in the middle part of 2025. Now it's back more like 3.25%, and that's before we put the energy shock on top of that. And that energy shock is already going to add 1% to the CPI in this month. But while that picture on the left looks nice, going nicely back to 2.5%, the picture on the right doesn't look as nice. And this is where the CPI is and where it's been. So you can see previously it took nearly 12 years for the CPI to increase 30%. The RBA's forecasts in February had it rising 30% over 7 years, so almost twice the rate, and that was before this energy shock. So getting inflation back to target doesn't mean prices have fallen, and we all know that. We all hear a lot about the cost of living, and we experience that as consumers. But when we're running businesses, we have to think that the cost of living is also the cost of doing business. And that's much higher than it was 5 or 6 years ago. So when I'm looking at the outlook, and I am going to talk after this in more detail about the Middle East and then AI, what's the outlook? I always try and say, what are the big forces that we need to be thinking about? So I think all those longer-term megatrends, they are very big, and they're running through the economy for the next 5, 10, 15 years. So they're not going away. AI is a very big story. In the short term, it can cause a lot of capacity pressures. Medium term, there might be some long-term, job losses that really change society. And that was the biggest macro question for me. It still is. But in the short term, I've got a different macro shock that we have to analyse and work out how that's going to affect the economy. It's a derivative of geopolitics. It's the energy price shock. And I think in the short term, it's really how long does the Strait of Hormuz remain closed? Because as we all know, now know 20% of global oil production goes through there, 20% of gas, LNG goes through there, quite a lot of fertilizer, quite a lot of petrochemicals used for plastic. So a huge part of the global supply chain of energy and other products has just stopped. And if you think about your business, if you lost 20% of your suppliers or 20% of your customers for any length of time, it has very big implications. And of course, point 5, which I think was relevant, and it was the previous slide, this adds on top of the previous increases in costs and prices. We had interest rates moving up already in Australia. The last two were actually positives, but I think we have to downgrade them at the moment as long as oil prices are sustained. So certainly the US economy won't be as strong, but the AI spending boom and the data center rollout will continue. And then I was looking at a mini mining boom in Australia, and I think that's still relevant. Copper prices are still very high. Gold and silver prices, they've come back a bit, but they're still much higher than they were. And then, of course, we've got much higher energy prices. So that's going to be a positive for parts of mining, but higher energy prices are difficult for large parts of mining that don't benefit directly from selling higher energy. So here's a couple of headlines. When you think about what data can we see already, there's not a lot of data because most of the economic statistics we're seeing are for February, which is completely before this March invasion, or not invasion, conflict, military conflict. But there's been some very big rises in prices already, and that's one thing about oil prices is they flow very quickly and very broadly through the economy. So they start to have an impact straight away. So let's talk about the Middle East. When this first happened, I thought, okay, how should I analyse this? I actually went back to the Gulf War in 1990, and I remember that very well because it started on the 2nd of August. That is my birthday. That morning, the Reserve Bank actually cut interest rates, and five hours later, Saddam Hussein invaded Kuwait. So it was a big day. What happened was we saw oil prices, not surprisingly, rising sharply. Share markets fell, and bond yields actually rose on inflationary concerns. And that, what I call that Gulf War 1990 playbook, is exactly what's happened in this conflict. Now, what was really interesting then was in 1990, interest rates had been extremely high during 88 and 89. There was a commercial property boom, which was turning into a bust. And what we saw through this period, and I'll show you it in this chart, is actually that the unemployment rate rose quite substantially through these goalposts on the right when the Gulf War started to when the Desert Storm operation effectively ceased. So central banks actually focused on the most important domestic fundamental, and that was recession and rising unemployment, and they cut interest rates. Now, at the moment, I think the most important domestic fundamental to date is that inflation is already high and it's been above target for a long time, and it's going to go further above target. So that's going to make the central banks quite focused on inflation for some time. But if we get a recession and rising unemployment, central banks will tend to not worry about inflation. They will know it will come back down, and they will start looking at interest rates. So the second last dot point says, to me, the key is how high oil prices rise and how long they stay elevated. Now, this is another supply shock. It's the third successive supply shock. We remember COVID and how you couldn't get supply of many goods. In the US, they've had a tariff supply shock, increases the cost of producing many goods, and now an energy supply shock. Supply shocks are interesting. If you think about monetary policy, moving interest rates can't do anything to increase the amount of oil flowing through the Strait of Hormuz. So it's not a really good policy tool to address this sort of crisis. And I think coming, to Michael's question, that's a reason why the government's doing other policy. And everything I'm talking about, it's really got to remember that governments always respond to crises like they did in COVID. They form policies. So you can see the big rise in oil prices. You can see the drop in energy, in stock market pricing. I think the rise in oil prices, let's go to this question. So I think two questions I wanted to know is, and very relevant for credit managers, is what oil price would cause a global recession, right? Because recessions are very bad for business. They're very bad for insolvencies, and obviously they cause unemployment to increase. And in Australia, we really haven't had a recession since that Gulf War period, the early 1990s recession. So I asked AI, but I came up with my own answers beforehand. So AI got about the same as me. I was saying somewhere $125 to $140 per barrel. Sustained, I've said sustained, and AI came back with, you've got to get $130 to $150 a barrel, US dollars, both of those, for 1 to 2 quarters. That's equivalent to the price going up 50 to 70% year over year. So are we there yet? No, we're not there yet, but we're not that far off the low end of that number. And then the other question I asked was, what if you want to destroy that 20% of global oil demand to take out or balance, if you like, the market for the oil supply lost to the Strait of Hormuz closure, what do you have to do? How high do oil prices have to rise to reduce demand that much? 20% is a lot. So we really think twice about driving to the shops, or we carpool, we get public transport, we take less holidays, etc. And my guess was that could be somewhere around $200 a barrel. AI, which went away and looked at all elasticities and previous energy shock research, came up with an even higher number if we need to destroy, and it could be temporarily destroy, that 20% of oil demand. So you can see, I think, why, I think for me, the first story, the most important question is, how long is the Strait of Hormuz closed? Because 20% of supply is a huge amount of supply, and it could lead to prices that are, astronomical if the strait is closed for 3 or 4 months, because you have to destroy that demand. You can't get that oil from anywhere else. And those sorts of numbers, if they're sustained, would be easily enough to cause a recession. Now, again, that all sounds quite gloomy. It is. That's one end of the spectrum of scenarios. The other end is, as I said a bit earlier, we wake up and the president has decided he's achieved his military objectives, his regime change objectives. Are we there yet? I think oil prices at currently about $110 $10 are effectively pricing. They're not pricing either of these scenarios. They're not pricing an extended period of the strait being closed, because it would be much higher. So they're probably leaning towards a little bit of optimism there.
Sorry, we've just had a question come in from Paul. He's asked, in the first scenario, can stagflation play into this in the next 12 months?
Yeah, it's a good question, Paul. I think the term stagflation has been used a lot in the last 3 or 4 years since COVID. And I think it's been used really incorrectly in that period. So stagflation historically was the early to mid 1970s, when we had this period where there was very high inflation and very high unemployment coexisting, and very slow growth. Now, if you think about the last couple of years, I would say we had high inflation for a while, for a couple of years. We didn't have the sorts of very high inflation that we saw in the early 70s, and they were 10s, 15, 20% inflation. And we certainly haven't had very high unemployment, thankfully. At the current juncture, I think there is that risk of high inflation and high unemployment coexisting. If, again, it will depend if oil prices stay very high, and this is an extended period of 20% of lost oil production, then I think the impact on the global economy would be quite negative. The impact on inflation would stay high and unemployment would rise. So I think this is the most risk, the biggest risk we've seen of stagflation at this point in time. Thanks for the question, Paul. So what sectors are most at risk? Obviously those with very high direct fuel consumption and road freight we spoke about. And of course, that sector was already under a bit of pressure. Agriculture, mining, aviation all use a lot of fuel, and already all of these, and I think generally speaking, we're seeing fuel surcharges go on, price rises change.
If I could just ask a question about, obviously, agriculture, we've seen a 50% increase in the price of fertilizer in the past 12 months, the price of urea. How significantly do you expect the impact on agriculture to flow through to grocery prices?
Well, there's always a lag there, in that, it's production, all of these things, there's generally a lag. So I think one of the other issues that I probably haven't mentioned so far, but I've been only talking about price impacts at the moment, but the other issue is that there's the risk you can't get fuel. Doesn't matter what price it is, that there just aren't enough boats coming into Australia for the current demand of fuel. And that's one of the things the government is working already with in terms of what's the fuel security plan. So I think it's fair to say, to the extent prices stay high, it's going to come through the whole of the economy, Michael. It's no one is immune from higher oil prices in a cost sense. So yes, I think it will add to it. But again, it's possible that this is a short-lived shot, right? It's been a nasty shot, but it could be short-lived. It depends on that whole situation in the Middle East. But at the moment, what we know is oil prices are high, energy prices are high. There's some interruption to supplies, and this is going to add to costs. And we're seeing it already in construction costs, which are going up. Manufacturing will go up, agriculture, mining, aviation, etc. And then there's, I put obviously there's energy intensive production, which construction uses a lot of, manufacturing does, sectors with long fuel supply chains. And then I call them adjacent sectors. I mean, travel and tourism is a bit, different from aviation, but you can see on the news that people are worrying about their Easter travel plans. Will they be able to get sufficient fuel rather than drive, for 10 hours to Byron and back? So, yeah. And then of course consumers get impacted. So discretionary spending. Now, I don't know that that's had a big impact yet, but the longer it stays up, the more impact. So what we've seen so far, I think it's really too early in terms of economic statistics or company data, but we know the direction of travel. We know what much higher costs mean. I am seeing, this is a series I follow in the US, which is daily job advertisements. And you can see right at the end there that there's a bit of a drop already happening. And that's what I'd expect in Australia. So while I haven't seen any data, I know that when I see the next consumer confidence reading, it's going to be much lower. When I see the next NAB business survey, it's going to be much lower. And when we start to see other data come through, like job ads, they should be signalling that things are deteriorating. And I imagine a lot of business would already be feeling the cost side of it and might be starting to see some impact on demand as well. So the final slide before I go to the questions, the government has come up with a fuel security plan. That means supply of fuel. I would say it's reasonably conceptual at this stage. We're at stage 2, which is keep Australia moving. It's encouraging people voluntarily not to fill up their tanks when they don't need to. It has a stage 4, which involves direction of fuel supply, which is fuel rationing. The government has indicated, and I should say government, so it's state and federal. They've had the National Cabinet again. They can see that we have fuel supplies currently secure until May. That's not that far away. We're about to reach April tomorrow. And, driving around Sydney on Sunday, there were petrol stations lots without diesel, some without other fuels. So they've also taken the action to try and reduce the impact of costs on consumers and businesses. And they are helpful in a sense in reducing the impact on cash flows and also reducing published inflation in the short term. But these measures they've taken are not big enough to offset the full shock that we've seen. So we're still back at the main question. If I wanted to know one question, it would be how long will the Strait of Hormuz remain closed? Because the longer it does, the worse it is for oil prices, cash flows, insolvencies and growth. Okay, let's go to the questions.
Okay, so Hamish is interested to know your views on what the long tail effect of this might be. So I guess if the Strait of Hormuz was to open in the next few days, what might the long tail effect of that be?
Yeah, good question, Hamish. Look, I think that would be a big positive. The oil price, which is currently around 110, I think that would come back to 80 or 90 in a pretty short time. And, because the biggest effect is 20% of supply has been taken out of the market. The secondary effect is that there's been damage to energy producing infrastructure in the region. And that I don't think that's, and I don't know, but it's it would not be as much as 20% of supply coming out of the market. So let's say it was 5%, that would keep oil prices a bit higher than they were heading into the conflict. But also before the conflict, we had a situation where there was too much oil in the world, and oil prices were, reasonably well behaved. So I think that context is important, but reopening the strait would be very important straight away. Excuse that pun. And then I think some of the other longer term issues is governments around the world will decide that they don't want to be as reliant on fuel supplies from the Middle East. So probably there'll be more pipelines going across from the east side of Saudi Arabia, I think it is, to the western side to get oil and gas out without going through the Strait of Hormuz. We might actually decide we need to have more refineries here, etc. There will be some other decisions like happened out of COVID, where the US decided it didn't want to be as reliant on Taiwan for semiconductors.
Thanks for that. And then a couple of people are interested to know how Australia is positioned by global standards. So one person has said in terms of recession risk, and another in terms of oil supply.
I think in terms of recession risk, we're very similar in that consumers are a big part of the economy, and oil prices, we're just similar to the US economy and other advanced economies. Big energy price rises in the past have caused recessions. They have to be sustained. So I don't think we're much different on that front. In terms of energy supply, that's an interesting one, because while we actually import a lot more fuel than, we rely on imported refined fuel products, let me put it that way. We're a massive net energy exporter. We send so much gas to the rest of the world, so much coal, and we also export oil. But those refined products for our cars, for our trucks, most of those come from overseas. So that's our choke point. I guess being such a big energy exporter, maybe we have some leverage where we can negotiate extra access to fuel with other nations that have fuel. But do they have a lot of surplus fuel? Probably China has enough for us, given we're relatively small, 27 million. So that's the one I think we've got some negotiation. But the problem is, again, if you've got 20% of world supply out, then that's a problem for everyone. The US maybe is in a better situation. It's entirely self-sufficient. But again, their prices have gone up, and it's a global trading system for oil.
We've got a few questions, but I might just hit you with one more before we keep going, and we can try and get to the others at the end. Given that rising fuel costs are increasing construction costs, how do you see this interacting with the government's focus on increasing the housing supply, and also the infrastructure pipeline for the Brisbane 2032 Olympics? Are we risking crowding out housing supply or reducing project viability, particularly for residential developments?
Yeah, well, it's another cost shock, like it's a supply shock. So it depends very much how long it lasts. If it unwinds or reverses in the next 1 or 2 weeks, then we'll go back to where we were, largely go back to where we were. And that is the Olympics has to be built by, before 2032. It may actually, you hear about how challenging it is to get tradies, etc., in Brisbane, southeast Queensland. So if it's more expensive to build houses, it will be a challenge for the government trying to get that 1.5 million target. It's already a challenge. So higher prices will mean that people won't probably do as much renovation, and there may not be as much demand for housing. So it will be a challenge. It may free up some, labour or capacity if prices remain high out of residential back into the infrastructure pipeline. But again, all of this, I have to stress, is conditional on how long and how high prices get and how long they remain elevated. And so, hopefully we're not talking about this in 2 weeks' time. That would be the best outcome for everyone, I think, for the economy. But it's possible we are.
Keith has asked, can we expect any more government stimulus beyond the cut to the fuel excise?
Yeah, look, I think sort of answered a like question, not a like question, or made the observation, is that governments don't sit still in times of crisis. So they will look at what needs to happen. And again, it's interesting because one part of the fuel security plan is a rationing plan. And that won't keep Australia moving if we don't have enough energy at some time. And just think, if you can't drive to the shops as much or you can't go out, it will change activity. It will be like lockdowns where activity sort of stops, and there's an interruption. And in that environment, remember in COVID, the government put in place Job Seeker and Job Keeper. I would say it's way too early to start talking about that. But in the worst case, where activity grinds to a halt, then they probably think about stuff like that again. So yeah, I'd say definitely they'll make policy for the evolving situation.
And sort of similar line of questioning, but on the RBA side, how far do you think they will go with interest rates to curb inflation?
Yeah, that's a really interesting one, because it sort of comes back to the stagflation question. And if you look at the Fed, they've been using a framework where, like Australia, they want to keep unemployment low and inflation low, right? And those two can be in what does the Fed Governor Chair call it? Tension. So you can get the mandates moving in different directions. So stagflation would have very high inflation, which would make you want to put up interest rates, but also very high unemployment, which would make you want to lower interest rates. And the way the Fed's approached that has been to say, we want to look at how big is the deviation from target, and how long do we think that deviation is going to last. So during COVID, when unemployment was already really low and inflation got to 8% in Australia, it was a very easy decision. You just have to attack inflation. It's a harder decision if, just making up numbers, but if inflation was at 5 or 6 and unemployment was at 7, then you're getting a different signal from each variable you're trying to target. So how far would the RBA go? Look, an energy shock is a negative shock for demand. I've seen one of the big economists, bank economists, forecast 3 rate hikes by the end of the year. That seems too many to me, given there'll be a negative shock for coming from fuel. If it's sustained, again, I've got to keep saying that because it may not be, and hopefully it won't be. So I've been tending to think 3's too many, 1's probably not a lot, so somewhere between 1 or 2 more. But yeah, I think the shock factor is an issue. And personally, if I was Reserve Bank Governor, I don't think I'd do anything in May. I think I'd wait and see what happens, because I've already moved interest rates twice in the last 2 months. That gets me to a setting where interest rates are not, they're not as low as they were. They're going to be impacting some restraint on the economy. Fuel's impacting some restraint as well. And central banks always look through the first impact of price rises or fuel price rises because rates can't change the supply of oil. And then, in a couple of months' time, they'll know whether unemployment is going up a lot or whether the war has ended and oil prices are back down to $75 a barrel. So I think I'd be a bit cautious in May, would be what I'd do. Doesn't mean I don't think rates probably will go up a little bit more, but I'd just be a bit cautious.
Just a question on the on gas exports. What do you think the government would consider increasing the tax on gas exports, and what impacts might that have in terms of global trade?
Yeah, it's a good question. I mean, that they need to fund how they pay for this. They've announced the fuel excise tax being halved for 3 months. They've announced they'll return the extra GST and the heavy vehicle road user charge will be removed. That's one way they could address it, because the demand for energy will be extremely high. That's obviously something people would argue that it's like a resource rent tax or a mining tax. But other people have argued that we sell a lot of our resources too cheaply, and perhaps for Australians at a time of crisis, we could do that. So I don't know if they will, but if you wanted to raise some revenue for the short term, that's one way you could potentially do it.
Okay, thanks for that. Just one more. So what are the uncertainties going forward? Obviously, whatever's going on in the head of President Trump is one of them. But outside of that, what are the other uncertainties that you see in all this?
Well, I mean, the US is only one of the actors in the conflict. So there's Israel and there's Iran. And I mean, the US might say they've achieved their objectives, but has Israel achieved its objectives? Is Iran prepared to play a different game and keep the Strait of Hormuz closed for a very long period of time and really have a very major impact on the world economies? So those are, I guess, parts of the uncertainties. The same uncertainty about how long does the Strait of Hormuz remain closed. How long are we dealing with this supply shock? That would be it's still my biggest uncertainty.
Thanks for that, Ivan. That's all the questions we have for now.
Excellent. Thank you, everyone, for your questions. And again, I've got this in the pack because it was, up until a month ago, was the whole story we were worrying about and trying to understand. And in the short term, I concluded that AI was going to boost the economy. It was going to actually probably be inflationary because this data center rollout was adding demand for copper and electricity and water and semiconductors. But in the longer term, there are all those questions about how much does it impact the job market. And it's probably not just AI, it's AI and technology. Technology keeps improving. Robots are improving as well. So that's still running at the same time as the energy price shock. It's still very important. I'm looking at various labour market data to see if I can see a significant change in layoffs or in job ads. And so far, if you look at this chart, the big rises in the blue line, the big sharp increases are typically they're cyclical downturns where unemployment rises. And if you saw a gradual uptrend, that would be a structural change like AI, which comes in over time. It doesn't just happen in one go. So to the extent we see an oil price shock should show up as more a cyclical turn and cyclical rise in layoffs and unemployment, an AI change should come through slowly. And these are the Reserve Bank forecasts from February. I think they're pretty relevant. But what I would say is follow the unemployment rate. That tells you what's happening in an economy, and job ads tell you how the unemployment rate's going to develop. So the indicators, those of you who've seen me present before, job ads are a key indicator. The NAB business survey is a key indicator. When this comes out for March, I expect to see it drop pretty sharply, and job ads will start to ease as well because there's uncertainty. So it's a more challenging environment, and it's unfortunately it's one we've got to be cautious about credit and hoping that this situation in the Middle East resolves sooner rather than later.
We certainly do. Thanks very much, Ivan. That was extremely informative as always. Thanks once again to everybody for joining us. We'll send out these slides to you via email. So look out for those, and we'll catch you next time. Thanks very much.